We're really thrilled to have Jason join us today. Jason Trennert is one of Wall Street's top thought leaders on the subject of markets and economic policy. Jason started Strategas in 2006. And for those of you who don't know, starting a firm on Wall Street is extremely difficult. And having a very successful one, as Jason does, is very difficult. The firm has 50 people right now with offices in New York, DC, and Ohio. Prior to Strategas, Jason was the chief investment strategist at the ISI Group, which is now a part of Evercore. And just as a side note, when I was helping to run research at Bear Stearns, I tried unsuccessfully to recruit Jason to our firm. And he was a very hot product and still is today. Jason is a regular guest on CNBC and Bloomberg. As a matter of fact, CNBC just featured a Strategas member, and the comment was, the street is too bullish on Amazon. Jason's also the author of 3 books on investing and the investment business. He holds a Bachelor of Science from Georgetown, so he's an alum, and an MBA from the Wharton School. And with that, I'll hand it over to Jason.
Thanks. Thanks a lot, Tom, and thanks a lot, Professor Pinkowitz. Thank you all for joining me at the end of a long day. I'm sure everyone's exhausted. I was telling Tom and Lee that I have to say I'm heartbroken that I'm not there. Because I loved going to school at Georgetown, and I will say I was kind of hoping all of you would take me to the tombs afterwards for a couple of pictures. I don't know how much they cost now, probably like $30 or something, but when I was there, $10 was kind of like the outer limit of what we would pay. And I'm going to spend maybe 5 to 10 minutes just talking a little bit about myself, the least interesting part. I'll spend maybe 25 minutes talking about the markets. And then if there's some time, maybe we would talk a little bit just about my impressions of the street or, a career on Wall Street or some of the things I learned if you have an interest. But we'll try to hit a bunch of everything. And the most important thing is that we leave plenty of time for Q&A, because that's the most important thing for everyone. I've been a student, and I also have been a conference attendee and speak at conferences, and I've kind of learned, after 20 minutes, people start thinking about winning the Masters or, motorcycling in China or whatever their personal fantasy is. They start thinking about that. So we're going to try to dispense with that, and if I can figure out, okay, you all see my handout here.
Looks good.
Yeah. Okay. So listen, just to give you a little bit of a sense of who I am. So I was graduated from Georgetown in 1990 with a Bachelor of Science, BS, as appropriately, in international economics. And I will say it was a different time in those days, because the whole intern thing was not as big a thing as it is now. So most of us would just get jobs after our freshman and sophomore years. And I worked at Burger King. I was a waiter at a catering hall. I was a doorman at a club. I did all those things. And then after my junior year, I got a job as a cold caller for a brokerage firm, and for brokers who are now called FAs, and Smith Barney out on Long Island. And kind of the crazy thing happened. I fell absolutely in love with the business, and I knew, it's kind of like a light bulb went off. I knew that that's what I wanted to do with my life. And then became an international economics major my senior year. So I took 6 economics classes my senior year with renewed vigor and ambition. I worked in the back office at Morgan Stanley for a year, and then I got kind of a very big break. I got a job with a brand new firm called ISI in those days, in 1991, almost a year to the day that I got a job at Morgan Stanley. And that really kind of changed my life. I did that for a couple of years. I went to Wharton Business School, and then I decided that I wanted to be a foreign exchange trader, because it sounded cool, and it sounded like it would be very exotic, and all sorts of cool things would happen to me. And then I learned that I hated it and I wasn't any good at it. And then I became an economist. I went back to ISI, built up a product for them called their company surveys, then started doing strategy. And then Tom told you, really just kind of hit my stride as a strategist. And then in 2006, I started this company. So, I haven't seen it all on Wall Street, but I've been around a while, and I love the business. It's changed a lot culturally, but I still think I feel this as I did when I first found the business in 1988, that I think it's one of the most intellectually stimulating businesses there is, or it can be. It isn't always that way, but at least for me and the way we do it and what I do, I find it to be a very intellectually stimulating business. And I think one of the myths, and we could talk about this a little bit later, is that you have to be a super quant to really enjoy it or be good at it. And I think quantitative skills are important, but qualitative skills are also very important as well, because it's, as I could talk about later, it's social science. It's not, there are elements of science in this, but you get in the biggest trouble in our business when you start to treat this like a hard science, like chemistry or physics, as opposed to something where you're dealing with other people. In the old days, which is like, let's say before 1975, which I think for you guys is probably, ancient history, there were a lot of firms like our firm, like Strategas, and they were called Wall Street Research Boutiques. They're still called Wall Street Research Boutiques, except there's fewer of them today than there were then. Before 1975, there were something on Wall Street called fixed commissions. And then there was a day in 1975 called the Big Bang, in which they went from fixed commissions to negotiated commissions, which meant that commissions fell dramatically. And then all of a sudden, the number of independent research boutiques fell dramatically. And that's also when, unfortunately, investment banking and research started to become a little bit more, let's say, closer, and probably too close, by the end of the 90s and all the rest of it. But that's kind of what I do. We were established in 2006, as Tom mentioned. We have 50 people involved in research, sales trading, capital markets, and asset management. We travel all around the world, all around the country. The macro-oriented means we do broad asset allocation, investment strategy, fixed income strategy, technical analysis, which is charting. We have a big Washington group that does policy work and that impact on the overall market. We also have capital markets activities, including non-deal roadshows, private market transactions, private markets, obviously, and some syndicate. We just launched 2 ETFs 2 weeks ago, the Strategas Macro Thematic Opportunities Fund and the Strategas Global Policy Opportunities Fund. We wound up selling the firm. We started in 2006, wound up selling the firm to Baird, R.W. Baird, out of Milwaukee in 2018. But we run completely independently, have our own broker-dealer, own management, all the rest of it. So it's been a great marriage between the two companies, and I could discuss that too if you're interested in some of the reasons why I went down that path in terms of starting my own company and also moving and partnering with Baird. One of the things that I wanted to just, I know this is, and I was told to go easy on the career advice here, because and I don't, it makes sense to me mainly because it's always changing, and what was relevant, 30 years ago isn't as relevant today. But I will say that one thing that won't change about the street is that it's extremely dynamic. And this is one thing, I think, just knowing what you're getting yourself into if you want to go into business, it's, and I think you can fear that, or you can just kind of embrace it and just say, this is kind of the way it is. And I always show this when I do a conference every year for interns in New York City. And I always show them this tombstone. And this in the old days, when you announce the sale of securities, you'd put what you call a tombstone in the newspaper because it kind of looks like a tombstone. But this was for American Motors Corporation in 1969. actually produced Jeeps for the U.S. military, and then started making Jeeps commercially. There are, if I'm not mistaken, I haven't counted in a while, I think there's 36 firms on this tombstone, and none of them exist today in their form, and certainly in the same form that they did then. And these were not small. I can tell you, these were not small firms. Working at White Weld in the late 60s and 70s wouldn't be that different than getting a job at Goldman Sachs or something. Now, in these days, all of these firms were private partnerships. They didn't have permanent capital. So it's a little different. But by the same token, even 13 years ago, who would have thought Merrill Lynch, Bear Stearns, or Lehman Brothers would no longer be with us? And so anyway, that's the story there. This is a little bit of a day in the life. Look at this at your leisure, but we start every morning at 7:30. We go around the horn. We have 7 publishing research analysts. I personally produce about 80 to 100 reports a year. All of my analysts publish about the same number, if not more. We forecast earnings, market direction, leadership, asset allocation. I travel a lot to visit clients, and one of the things I'd like to talk about a little bit later is I feel very strongly that travel enhances the research process. And when I say that, it's because I feel quite strongly that when you live in New York or DC or LA or San Francisco, you're missing a big part of the country. And I spend a lot of time everywhere, everywhere from Louisville to Omaha to LA to Boston. And it enhances our understanding of the world very dramatically. And it's helped us make a lot of good calls over the years. And we make good calls, make bad calls, but mixing it up with regular people and in other parts of the country, I think is very, very important as a financial analyst. I think our work, when I talk to clients, I think it can be useful in 4 ways. One is we could be correct on the markets, which is that's about 50-50. I'd say maybe it's a little better than that. What you're hoping, though, is that the 50 where you're wrong doesn't bury you, right? That's what you're trying to do, is to be light on your feet, and make sure that your mistakes aren't that costly, and then kind of let your winners run. By identifying big investment themes, things that are going to be around for a while, the wind is very much at your back. As I mentioned, this is why the travel is important, where the consensus lies, which is extremely important in the investment business, because it's really a lot about what's priced in. And then finally, we just produce a lot of charts and data to allow our clients to make up their own minds. And so those are the ways we try to be helpful, and that's the way we get paid. I think I would say, just from a more personal note, I think probably the defining moment of our company at Strategas was the day Bear Stearns failed. It was a Sunday evening, and I remember I had a very young son at the time, and we were just about to sit down and eat dinner, and I had my BlackBerry at the time, and I saw the announcement come through. And then at that point, we had about 20 people in the firm, and I called everybody into the office that could make it that evening, and we published a report probably at 10 or 11 at night, and was on the phone probably till, I don't know, well into the early morning, talking to clients from all around the world. And it really, I think, when you're small like us, we aren't going to be the first call. People aren't rushing to give us business, but it's by being accessible that we became really relevant. I was telling Tom before too, most of our clients would describe themselves as bottom-up analysts or stock pickers, and in mostly good times, they say we don't really care about the macro, we just care about our stocks. But macro doesn't matter until it matters a lot. And then it's like the only thing that makes a difference. And so we were, in that evening, I'll never forget it, we were getting calls from people that were running $4 or $5 billion hedge funds that wanted us to describe to them what the discount window at the Fed was, or how it worked, and how the haircuts worked, and things that, again, they had learned, it just was not relevant to them for a long period of time. and became very relevant very, very quickly. So anyway, that is a brief update before I kind of go into the way I think and what I'm thinking now. Maybe Lee, I'll stop here. I think you might want to do another.
Yeah. So we want to get you guys involved. And I've got a question for you, Jason, but I'll hold off on it. But we'd like to make you guys have to take a stand. When you're an analyst, one of the things you have to do is take a stand. So here's what I would like you to do. You can only pick one of these. Today, the S&P closed at 45.21, folks. The question is, where do you believe it will end? It will be at year end 2022, right? So, and I've got them in bins, right? Will it be down more than 25% from the level, down between 15 and 25, down 5 and 15, flat? I'm calling between 5, up at 5 and down 5, as I'm going to call flat for the rest of the year. So let's just see where you guys think this will be. Obviously, you will have your own reasons for this, right? Some of them might be top down, as Jason is sort of saying, on the macro level. Some of them could be on the basis of just what you believe investor psychology will be. I'll show you what we have so you guys can see the, here we go. So Jason, this group looks a little more perhaps bullish than bearish, although we're pretty much in a they're in a very narrow range here, right? Looks like, what is that? Yep. Almost 90% roughly is basically saying no more than 15% swing, right, from where we are, which is probably around a little bit less than the standard deviation of the market over the past,
that's probably right.
70 years. Okay.
Right.
So we can talk more about this as going forward, but thank you guys for sharing that. Jason, did you want to tell them why they're wrong?
No, well, listen, and before I get started on my talk, I just have two disclaimers, and it very much, it fits very much with what you just did. And by the way, what Lee just did here, or Professor Pinkowitz, I do all the time. So I've been, meaning like so far this year, I think where have I been? I've been to Pittsburgh, Louisville, Omaha, Miami, trying to think where I've been. I've been everywhere. And I do group luncheons, and I do exactly what we just did. But I ask more questions. I ask where 10-year treasury yields are going to be, or gold, or other things. But I do this all the time, and it speaks to really what we're trying to do is really this investment dialectic that I have here, which is like, what are you trying to do as an investment analyst? In my opinion, you're trying to find a variant perception, something that's very different than what the consensus believes, and then trying to figure out a catalyst that might make those two things come together. And that's generally where big money is made. But the first thing you have to do is figure out where the consensus is. And so you don't want to be in the consensus. And I'm not saying my own guess, I won't keep you in suspense because it doesn't matter. What I think. My own opinion is I'm kind of more in the flat category, which is, very unsatisfying. I will say though, knowing as the professor does, when it comes to market expectations, generally speaking, the tails are fat, meaning it's not a normal distribution. That the things that you think could never happen, they happen a lot more frequently than a normal distribution. And just to ask long-term capital management, right? I mean, those things happen all the time. And that's why it's important to know where the consensus lies, know where you're taking risk. And so this is very useful. And I have to say, if it's okay, I might use this in my own report if I'm allowed to do that. Because I always publish the results of wherever I am, and so because our clients find it very interesting too. That's what they're trying to do. So two disclaimers before I get started here. One is there's John Kenneth Galbraith, famous economist, said there's two types of economists: those that don't know and those that don't know they don't know. And I am very much in the I know I don't know category, right? I think humility is an extremely important element in doing what I do. I think it's an extremely important element in successful investing. And it means, again, being light on your feet and making sure you're not run over. The biggest mistakes, ironically, in this business, I've noticed, are generally made by the smartest people, and people are really smart. And the problem is, they're so smart they tend to believe they're smarter than the market. Which obviously, if you're kind of an efficient market person, you kind of think that's hard to do. It's hard to be smarter than the market because the market reflects all the information that's out there. And I mentioned long-term capital, but to me, it's one of the greatest examples. When Genius failed, was the book, but Barton Biggs was a very famous strategist at Morgan Stanley many years ago. Said long-term capital might have survived if they had just hired one Nobel laureate in economics. But once they hired their second Nobel laureate in economics, it was over. Like there was no chance of them succeeding. And there's an element of truth, I think in that. And again, I want to emphasize the humility. The second thing is I'm going to have to talk a little bit about politics here in the next 20 minutes, and I don't want to offend anyone's politics. I'm just trying to get to the right answer. That's what our clients pay us to do, get us to the right answer in terms of the markets dispassionately. And so that might annoy you, or I apologize, but I'm just gonna kind of tell you what I think or the way I'm seeing it. So I start with first principles, and first principles, which I kind of go through, start now in terms of a bullet point based case, are what causes recessions, and is a recession likely now, and then also what's the policy backdrop. And I would say what causes recessions, in my opinion, there's really three things: the Fed fighting inflation, or the central bank fighting inflation very aggressively, a policy error of some sort. So that could be another policy error. Could be tightening too much on the part of the central bank. It could be in an opportune tax increase, like the VAT increase in Japan in the late 90s. Something, or trade war, things along those lines that happens. In the 30s, we made every policy error you could make, monetary, fiscal, regulatory, and trade. We made all four of them simultaneously. That's why it became the Depression. And then there's always a chance of a recession based on an exogenous event. So that would be something like 9/11 or COVID, or obviously there are things that can always happen that are beyond everyone's control or beyond anyone's ability to forecast. But this is kind of how I get started. And I can come back to, just to kind of keep things moving, these are kind of things that I pay a lot of attention to. I mean, there's 16 elements on here that we pay attention to when we try to put them in either assets or liabilities, but it gives you a sense of, a lot of people talk a big game about macro, but there's a lot that goes into it. A lot of things, a lot of moving parts. And the hard part is not so much identifying what's important for the markets, because all these things are important. It's figuring out how important they are at any given time. And this is kind of the latest that we've done here. We did this in December. Kind of came out as flattish, at least for the S&P 500. I could talk about these elements a little bit later in Q&A, but without further ado, let me get to the real thing. Let me talk about what we're thinking today. So going back to first principles, the first thing I'd say is that the chances of a recession, in my opinion, over the next 12 to 18 months are pretty low, or quite low. And that's because we still have very accommodative monetary policy. As a matter of fact, the Fed's still easing, in which it's hard to believe, but they are. We have a positive sloping yield curve, very important. Credit spreads are still pretty tight, although they're widening out a little bit, but credit spreads are pretty tight. And there's an enormous amount of corporate and personal savings. And the labor markets are tight too. So you put all those things together, you say, hard to get a recession out of that. I feel very strongly that you should be looking at both nominal as well as real GDP, which means you want to add inflation to it, because that's going to give you, a very good understanding of kind of how much risk you want to be taking. And what I spend a lot of time doing, and this is maybe a function when I started in the business, I spent a lot of time looking at liquidity and money growth. And I compare liquidity and money growth relative to nominal GDP. And if money growth is growing faster than nominal GDP, I know I'm probably not in that much trouble. If it's not, I know that I got to look out below. Right now, money M2 is growing at about 13%. Nominal is a little lower, not a lot lower in the latest iteration, but you're still okay. But you are at I think on the cusp of a pretty significant regime change as far as monetary policy is concerned, and we can talk about that. I believe pretty strongly that inflation is not transitory, and I felt that way for a year. I think it's more structural. I am very skeptical that inflation will go back to pre-pandemic levels of change, which is about 2% for a long time to come. I think there's a risk that it could be a lot higher than that. I'm kind of using something in the order of something like 4% inflation for this year, and we have a pretty strong bias towards value-oriented sectors, energy, materials, financials, and industrials. And I will say, again, I also will identify when we've been dead wrong on stuff, but I would say that the value call and the inflation call were things that we've had we feel pretty proud of those. We've had those for about a year. We're not kind of Johnny-come-latelys on that. We've been somewhat cautious on tech, particularly high-flying tech, for probably the last 4 or 5 months. The reason, I'll just show you this, I'm going to bounce around here, is really that there's 2 things going on. One is that we think there's a chance, because we think inflation is more structural, we think long-term interest rates are likely to increase pretty dramatically. And that doesn't set up particularly well with the number of high-flying stocks that you have in the markets today. This is a Russell 3000, and this shows you the number of companies that are trading at 10 times sales. There's a very famous quote by Larry Ellison at Oracle about what you have to do to justify paying 10 times sales for a company. But the bottom line is you have to assume that every dollar of revenue goes directly to the shareholders and then some, which is either illegal or impossible. So free money covers a multitude of sins. And we've had free money for a long time, but the bill is coming due now in the form of higher inflation. And in my opinion, higher long-term interest rates. And that is what you're seeing reflected in the markets really over the last 4 or 5 weeks. And in my opinion, it's likely going to continue. Going back to kind of where we were before on terms of inflation, I won't go through all of these bullet points mercifully for you, but I think there's 3 things I would point to that tell me that inflation is going to be a lot stickier than people think. The first is simply that rents, which are a big part of CPI, the amount you pay for shelter, generally tend to follow housing prices. And housing prices over the last year in the United States are up 20% year over year. Which I would argue with a market the size of the United States real estate market, and the maturity of the real estate market in the United States is really would indicate that there's a policy error that shouldn't happen unless the Fed is overly stimulative. But in any event, rents are going to be higher for longer. Secondly, I would argue that we have an employment issue. And as you can see here on the bottom right-hand side, we're still about 3 million people short in the labor force of where we were before the pandemic. The U.S. is a very service-oriented economy. About 90% of it is services, a little less. About 10% is manufacturing. This is a problem in a service-oriented economy because it's hard to automate a waiter or someone who's checking you in, or a flight attendant or a pilot, or all the things that we rely on. And as a result, people are having to pay up for labor. And that's not easily. There's a lot of theories we could talk about as a Q&A as to why all these people haven't come back to the workforce. But we could debate that. But the fact of the matter is it's going to take a while to get those people back in. And then lastly, I would argue pretty strenuously here that the environmental policies that we have right now are creating an artificial shortage of oil and gas which is causing prices to be higher, and it's creating artificial demand for industrial metals, particularly industrial metals that go into electric vehicles. So, cobalt, manganese, lithium, go on down the list, copper. And so until the environmental policies change, or if they change, this is going to be something that's going to be around for a while. It's going to cause inflation to be a little bit higher longer, in my opinion, than what might ordinarily be the case. So that's kind of what I've got on inflation. I just saw a headline this morning about
Jason, sorry, before
Yep.
you move,
Sure.
there's a great question in the chat from Gautam about actually fits on two of your what I think were on liabilities sides. How might an impact of the Russia-Ukraine situation have an? First of all, it's a war and peace issue, but then
Right.
also Gautam points out correctly here, how might it affect inflation and oil prices? Right. Certainly, Biden has come out now and said that they could cut down the pipeline. Are those things material enough to be factored into your model, and how do you try and predict those types of things?
Well, and I would say, to be very fair, be very honest, I try very hard not to predict geopolitical events because, and I would say we have 4 conferences a year, and we hire, we just had a conference 3 weeks ago. We hired General Petraeus to speak to our clients. And I have to say, not to be overly cynical about it, but the fact of the matter is they know a lot, but everyone's guessing. And so that's why I think we have technical analysis and we watch the markets themselves. And it's not to say that surprises can't happen, but in my experience, the markets generally tend to sniff these things out before the experts do. And so I don't say I'm ignoring it. I'm looking at it, kind of on the corner of my eye. Certainly, if that were to happen, it wouldn't surprise me if oil hit 120 in a matter of days. Then the U.S. administration would have to make a choice as to whether it would stick with its current environmental policies or perhaps ease them in terms of, let's say, drilling on federal lands or other things to make up the difference. But I know that's an unsatisfying answer, but I can't say I have to say, for the most part, I'm much more worried about inflation and the Fed slamming on the brakes than I am about some of the geopolitical risks. But you always have to be cognizant of them, right? I also think, to be fair, this is a slow-moving geopolitical event, but it's a very important one, is that I feel very strongly that our relationship with China will never be the same. I think China's relationship with the rest of the world will never be the way it was from 1997 through 2019. That the pandemic has irrevocably broken that trust, and the movement towards globalization, in my view, I take no pleasure in saying this, I think is going to be harder. And globalization is a significant driver of lower inflation and high profits. And so, that's another geopolitical event. It's not necessarily something that you're going to see right away, but there's no question in my mind that it's a very big moving part.
He's got another great question about this is more structural. It was a question that I actually something, but his question is about the labor shortage we've been seeing, as you mentioned. What kind of a long-term impact is it, and is there a fix in your opinion? Do you think this could bring immigration reform, or are we going to see an increase in wages, which is unsustainable, in Gautam's opinion?
The fun part about what I do, right, is that there's no real answers, right? It's not like chemistry or something. You can you get paid to think. And in my opinion, some of the problems in the labor market are structural, which is to say, I think particularly as it relates to the middle class, I think that this maybe goes back to China, but I do think that the middle class in the United States has gotten hollowed out quite a bit. And the problem, as I see it, is that it's very hard for middle class people these days to make a living and have the same sort of lifestyle they had in the post-war period. Part of that is due to globalization. Part of that is Part of that is due to trade policies that I think favored elites over regular people. I think part of it's frankly a monetary policy that favored elites over regular people. The best way to deal with this, in my view, and I'm a very free market person, but the best way to deal with this, in my opinion, is through productivity, through capital spending, and is trying to create industries in the United States in which people that don't necessarily have a college education can participate in and make a good living. That I think has become, because the economy is so service oriented right now, that's been very, very difficult for people, particularly people who don't have a college education, which is not an insignificant portion of the population. It's about, I want to say it's about 65% of the adult population in the United States doesn't have a 4-year degree. It's hard. And so what I would like to see, and this could be a gift, this kind of, if there's a rupture might be a strong word, but if there's a little bit of a break with China, the silver lining of that is we may start doing more things here at home in the United States. It may hurt profit margins. It may not be perfectly efficient, but it also might be quite good for the country, right? And then, so, and again, all of this stuff, I have to say, part of, because I'm talking about politics too, I try very hard. I kind of wear my patriotism out on my sleeve and all the rest of it, but I'm just trying to get to the right answer too on the markets, right? So, and that may or may not be great for the stock market, what I just said. It would be very good for people, very good for the country, in my opinion, but it may not be that great for the market because we benefited dramatically from a lot of these trade policies. But anyway, long-winded answer to your question is I would say if the U.S. could look a little bit more like, let's say, Germany. Germany is very export-oriented. It has a lot of high-end capital goods. Has an apprenticeship program, which allows people, again, that aren't necessarily going to go to college, allows them to be very productive members of society. That, to me, is a model that we should try to emulate if we can.
The follow on there, and this is, as I was telling Tom yesterday, I always tell my students, I'm not smarter, I've just lived on the planet longer. All right, which is that we've seen generational shifts, right? There's a discussion, I mean, the whole idea of the labor market now, when you start talking about Gen Z and millennials, it's a very different type of labor market in terms of demand, whether you're talking about college educated or not. Do you have any insights, or as a macro person, do you start trying to think about, does the labor market structurally change in terms of demand, whether it's work from home or people jumping jobs every X number of years,
Yeah.
or work-life balance, for lack of a better term?
Lee, this may be unpopular view, but I'm not sure. I know it's unpopular with my staff when I say this, but we're not going to really know until we go through another recession, and we're not going to know until we really have another bear market. And I was in a meeting last week where a young person was insistent and knew for sure that companies would never have 5-day-a-week jobs ever again because the demand for talent would be so great that they would have to make accommodations. And he was in our business, and I would say our business doesn't require a ton of talent. I mean, I don't know what he seems to have a pretty high opinion of himself. In my opinion, is a lot of it's effort, and I do think accommodations will be made, but again, I think they need to be stress tested. And one of the things I feel very strongly about is that in an era of free money, in an era of quantitative easing, in an era of financial repression, we have not been stress tested as an economy really since the global financial crisis. And even the recession we had after the pandemic, the bear market that was associated with that recession lasted 3 weeks. That's not, it really doesn't count. I think, and so again, the answer on all of these questions, Lee, is I know I don't know. I do think, I would suspect on Wall Street that there's going to be some sort of hybrid work for the time being. I know there is here. I got everybody back in the office last Wednesday, but we're not being hard asses about it, especially because not everything is open. And so childcare might be harder to get, or other things. Train schedules are not running, and all the stuff. And we're doing the best we can. I do think we're better to. I think some industries like Wall Street. I feel very strongly about this. People are better together than on Zoom, right? And especially for young people. I don't want to get on. I don't want to lecture you, but you should be in the office a lot. If you really want, it's hard to get, I was told when I got started in the business, no one ever got promoted at the Christmas party, right? Which is like, take it easy at the Christmas party. I'd also say, no one ever get promoted at home. It's not going to be so easy.
Jason, I was holding this question for later, but I think it might be appropriate now. So every time the Fed raises interest rates or pulls back liquidity, as you said, when there's a lot of liquidity, a lot of things get covered up. And there's an old saying, 3 steps and a stumble. There's lots of, in 2008, I talked to the famous head of Tiger and said, so the Fed's raising rates, so what's going to go wrong? So here we are, we're on the precipice of the Fed pulling back. You're about to show QE. They're also pulling back. They're going to start raising rates in March. So the real question is, so what's going to go wrong this time?
Yeah, so this, and that's and I think that's the right way to think about it. It's kind of a gloomy way. I will say it's a macabre way of thinking about things, but I also believe, generally speaking, the Fed tightens until something breaks. It's usually the way it works. And it could be 3 steps and a stumble. I think it generally doesn't happen immediately, because when the Fed tightens, the Fed gives the market a lot of heads up. When the Fed eases, it can do so overnight. You're not worried about anybody getting blown up or being on the wrong side of a trade when you're easing, or if somebody does get caught on the wrong side of the trade, they probably deserved it or something. When you're tightening, you want to give people a lot of leeway. And so Tom, not to patronize you, but I'm trying to find this. We did a piece just recently where we asked the question, what's overcapitalized, what's undercapitalized, where's the next financial crisis? Naturally, I'm having a hard time finding it as I'm talking about it. But the things I would think about, the things that are where is the most capital flown during? So I'm showing you here. This is page 16. This is the Fed's balance sheet, assets on the Fed's balance sheet, which are up 10 times since the financial crisis. These are stock prices, which are up more than 4 times. And here's inflation and wages. Okay. So I just say, well, what I say, well, you'd have to put crypto on the list. We could, again, these can be almost like bar fights. I'm sure with some of the people on the call, they would tell me I'm an idiot, for questioning it. But I think there's an awful lot of capital that's gone there. There's been an awful lot of capital that's gone to private equity. Been an awful lot of capital that's gone to venture capital. Risk parity is another strategy in the markets where a lot of money has been placed. And I'd also say international and emerging markets have been places where people have reached for yield. One of the problems with the Fed doing this, so Tom, I don't know if you got all those, or I should have done them slower because I have so much.
What was the first one? What was the first one?
So I say crypto,
Mm-hmm.
private equity, venture, risk parity, emerging markets. I think one of the things that one of the unintended consequences of keeping rates so low for so long is that it forces a lot of our clients, pension plans, endowments, foundations, to reach for yield and to make that they have a certain actuarial assumption. So if you're like this, let's just say you're the state of, I'll just make something, I'll make up somebody that's not a client, state of Alaska. It's probably not the greatest example. They're probably fine. But let's say state of, I don't know, Montana. They might have an actuarial assumption of 7.5%, which means they have to get 7.5% returns year in and year out to make sure that their retirees get paid and they fix all the liabilities that they have. The problem is if 10-year treasury yields are 150 or 2% and the market's trading at 20 times earnings, a lot of marginal things get funded. And this is one of the arguments against QE when it got started, when it really took off after the financial crisis. People said, once you start, it's very hard to stop without breaking something. And that's kind of what I feel now, is that the Fed may have to make a choice between saving asset prices and fighting inflation. For most of this period of time that I'm showing you here, inflation was less, in this whole period of time, inflation wasn't really much more than 2%. So, and this, I believe Trump's election and Brexit, so this is kind of a wacky view, but I think it had something to do with the fact that the policy mix that we had favored wealthy people so much more than it favored the average person. That if you're a wealthy person, you own stocks and bonds and private equity and all the rest of it, you did great. If you're just a regular guy that has a savings account, you get zero. You get zero on your savings account, which is somewhat it's not that acceptable really, but you can deal with it if inflation's 2% and your wages are growing. If your wages are growing 2% and inflation's 7%, it's a problem. It's a big political problem. And this is a little bit where the Fed is finding itself. This is a little bit, in my opinion, Fed's finding itself in a very tough spot here, because again, I think that they might have to choose between saving asset prices and fighting inflation. Let me show you one or two other charts here, and please let the questions keep coming in, because I think it's better than me just droning on. This is one of the things I'm looking at pretty closely. This is the real Fed funds rate. And so this is the Fed funds rate, which is now at 0, as you know, minus the core PCE. And the core PCE is the Fed's favored inflation measure. PCE stands for personal consumption expenditures, and core means you get rid of the things that keep you warm or allow you to feed yourself. For some reason, that's core, but it seems it doesn't seem like a great idea to exclude food and energy, but that seems pretty core to me. But anyway, that's what the Fed does. But right now, the real Fed funds rate is -5, okay, based on this measure of -4.9. So for our clients, and again, and I know I don't know, but for my clients that swear to me, they say, listen, Jason, you're missing it. You're too worried about inflation. Inflation's going to come down. You'll see. What I say in response is I say, well, let's say all of our prayers were answered. And let's say at the end of this year, inflation was 2% instead of 7 or instead of 5, if you're using here. What's the right number for the Fed funds rate? Is it appropriate that you would have a negative real yield on the Fed funds rate? And so I guess my point is no, right? The answer is that, the Fed funds rate probably should be at least 1.5 to 2 right now. And so there's a long way to go. And I think we're just at the very beginning of this process. And that's why, I'm kind of in the flat category, as I mentioned before, in terms of where I see the market, mainly because I do think there's a lot of earnings and there's a lot of strong companies, and interest rates are extraordinarily low. So if you have earnings, those future cash flows are being discounted by relatively low interest rates. But if you don't have earnings or cash flows, it's going to be a problem.
So Jason, to try and throw some other question here, one that doesn't come from Gautam. Actually, Will Bosso, who is on the board of GIFT, the Graduate Investment Fund, and I happened to know during their meeting last night they were talking about business cycle. He's asking about, some shops have said that we've been, quote, mid-cycle basically for a decade. Do you think that the changes in inflation, labor demand, monetary policy, does that signal a shift to late cycle phase? And if so, how long will the business cycle last? How will we know when it's over? As context, they were discussing the types of sectors that tend to do well in different parts of the business cycle.
Right, and it's a great question. This is why I'm sorry to keep. When I was growing up, my parents blamed all of the world's ills on drug abuse. Like if there was a volcano in Indonesia, they were like, it's drugs, you know. And I find myself at my age, my advanced age, I'm blaming everything on the Federal Reserve for, you know, I think they're the source of all the world's problems, which is not fair, of course. But I think this is one of the problems with the Fed doing what it's doing is that you don't really know where you are in the business cycle, where things that would normally happen in the course of a business cycle haven't happened because the Fed has been doing this. This is the Fed's balance sheet. And this is kind of the way, if you look here in 06 and 07, this is kind of, you can't tell, but it was actually growing here in the 06, 07, 08, but that's about the pace it was growing before the financial crisis. Now you've done this and you have no idea where true north is. You have no idea. Nobody really goes out of business. It's almost impossible for hedge funds to make money because it's hard to be short anything for any length of time. My view is we're going to, what's the answer? It's, I still think we're mid-cycle. The Fed is going to, what's going to break it is when the Fed really slams on the brakes, I think, which could take another couple of years. I mean, that could be, that's not something that's going to happen imminently. And that's why I'm still, if I really thought a recession, that's why I started, you know, are we close to a recession? My answer is no. If we were close to recession, I think, Lee, you know, you would want to own consumer staples and utilities, and you'd want to own very defensive types of sectors. I don't, in my opinion, a lot of that stuff is on the come, or, you know, a lot of the inflationary things have not really gone through the system yet. One of the things I would show you here as an example, this is the weight of the energy sector in the S&P 500. Okay. So in 2008, it got as high as 16%. Actually, if you took this back to 1979, it was like, I think it was over 30%, if I'm not mistaken. Anyway, we're all the way, the S&P energy sector was up about 50% last year, and it's all the way up to 3.5% of the index. I guess my view is this will be more, but before the cycle ends, this will be more like 10 or 15 or, you know, something meaningfully higher where the Fed feels like it's got to really put the brakes on. But that, I think it goes back to Tom's question before, you know, what are you looking for to break? What's, you know, how far does the Fed push it? And as I said, the Fed's still buying securities. It's incredible. The Fed's still easing, which is amazing to me. But anyway, any other questions or?
Just in the context of, if you could do it kind of in a brief overview, because you've mentioned it several times now, talking about the Fed's balance sheet, right?
Right.
Many of our people are not necessarily economists, right? And so, if you give it just, what does that mean in terms of the Fed balance sheet, and
right.
how, when they unwind it, why is this a problem?
Right. No, it's a great question. I apologize for all this stuff. All the stuff sounds so hard just because it's a different language, but it's all the same stuff. So the Fed's a bank, just like any other bank. And this chart is the assets on the Fed's balance sheet, on the bank's balance sheet. And as you may know, assets for a bank are loans. Okay, so what this is telling you is that the Fed has provided about $9 trillion worth of liquidity, $9 trillion worth of liquidity to the economy. Before 2008, it was about $800 billion, okay, and was growing at maybe 4 or 5%. So there are two tools there are many tools the Fed can use, but to tighten, the Fed right now can use two tools. One is it can raise the Fed funds rate through interest on excess reserves, which is the amount of reserves that banks deposit with the Fed. Right, so that gives an incentive to take money out of the banking system. It can also start to withdraw some of the liquidity it's provided by not purchasing securities. The way this grows, you call them loans, but they're really buying bonds. Same thing, right? But before 2008, 90% of the Fed's balance sheet was Treasury securities. Now it's everything. It's treasuries, it's mortgages, it's corporates in some cases after pandemic. The Fed was originally set up to be a lender of last resort. And the idea was if you were a bank, particularly, let's say, you were, just to use a simple example, the idea was if you were a bank in, let's say, Kansas, and you had a lot of agricultural loans and it didn't rain one season, and you had a lot of farmers that were going to go out of business, the local bank would go to the Fed and say, listen, we just need 3 months here, because as soon as it rains, all these guys will be liquid. They'll have money. They can pay back their loans. And that was the idea. And a lot of times that local bank would give the Fed treasury securities, would give them very high quality assets. In exchange, the Fed would give them cash. Unfortunately, after 2008, we started bailing out like everybody, and it was largely because we had to, and we started accepting things that weren't that secure. So again, mortgage-backed securities, corporate bonds, other things. So I'm sure I'm not doing a good job of explaining this, but this is basically a way of thinking of how much money the Fed has inserted or into the system.
So could we think of it as, people always talk about inflation. Well, why don't we just print more money? Well, we don't really print money. Can we think of this as, in essence, the Fed has printed money into the system?
Well, especially in light of, and I'm sorry, this is going to be like a shaggy dog thing. I hope everyone's, I don't know if we've lost anybody yet. People are bored to tears, but I would say that we have, because you would call it monetizing the debt. So it's not only what's really happening is there's this, I would say it's an unholy alliance between the Fed providing all this liquidity to buy treasury bonds, which are funding all of the spending that we did in the pandemic era. So the U.S. government, as you know, we're running massive deficits. We're going more and more into debt, and the Fed is largely buying a lot of the securities. And again, that's really kind of not kosher. It's really not the way the Fed was supposed to be set up. And that's why it's once you get started in these things, it's hard to do it. But to make a long story short, we are printing money. It's money in circulation. Cash is only, I would say, I don't even know if it's 10% of the money supply, 5% of them. I don't even know. It's a tiny percentage. I would say, I mentioned before, maybe one avenue to talk about is and I'm not just saying this because I'm an alumnus and I love the school and all the rest of it, but being someone who wants to go on to Wall Street and being in Washington, D.C. is increasingly important. And it's part of the reason why we have a Washington office. We have 5 people in Washington, and all they do is focus on policy. They focus on regulatory policies, and they focus on fiscal policies that are going to change the tax rate or spending. When I went to Georgetown, way back in the dark ages, very few Wall Street firms, almost no Wall Street firms, had Washington analysts, policy analysts. And actually, there was very little business in Washington, D.C. Like in terms of Fortune 500 companies, it would be like maybe the pharmaceutical industry would have the lobbyists there, maybe defense contractors. Now, today, every Fortune 500 company has an office in Washington, D.C. to try to lobby the government to do something, either to avoid something bad from happening, like a law that would hurt their business, or to get them in front of something good, like a contract. And so I guess this is a long-winded way of saying, take advantage as aspiring Wall Streeters or people who are interested in finance. I think it's unfortunate, but it's just the way the world works. We don't make the rules. Washington casts an enormous shadow over American business these days, global business. And so take advantage of that. Here I showed you, as Tom said, to use examples. I would say, I know this, people might not like this, but as an example, on a good call that we made, we thought that Donald Trump had a decent chance of winning in 2016. And that was largely based on the fact that I traveled all across the country and would talk to people. And it was pretty clear that, to me, that he had a good shot. So a lot of other firms kind of discounted what his policies were going to be, didn't pay any attention to him until after the election was over. And we didn't. We're like, all right, if he's elected, what is he going to do? And it was these four things: financial deregulation, corporate tax cut, energy independence, infrastructure. And so we were telling people, like, this is the playbook if he's elected. We were ready to go. Very few of our competitors were. When President Biden was elected, we were similarly, we were like, and we had the same thing for Trump. It wasn't that different, right? Because he was running for re-election. It wasn't going to be that different. President Biden, these are the four things he's going to focus on, right? And so this is something, again, where I think, that's an example of where it can really be helpful. You can get ahead of the curve. And I think, I know everything is very politicized right now. I know I follow politics extremely closely. But I do think if you're going to be in the business, you have to be very dispassionate about, try to draw a distinction between what you want to have happen and what is going to happen. And so we got plenty of hate mail on this when we would publish these reports. People would be like, "You're an idiot. He's never going to win. How can you even take this seriously?" Blah, 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 blah. And we're like, listen, this is our job to do this. And so, again, again goes back to maybe where we started. The tails are fat in the business, right? It's not a normal distribution. Unexpected things happen all the time. These are things that usually get people going. ESG investing, private equity, Bitcoin, that type of thing.
You had talked about charting, and so you, Tom, and I are from an older generation where we actually had to do charting, But the rise of big data and machine learning and AI, how is that going to impact, or how do you see that impacting both sort of macro forecasting, top-down forecasters, and for what most of our students want to do, they tend to be stock pickers, right, the bottom up. How is that changing that thing? It's just any thoughts you might have on that, whether Strategis is using it or certainly some of your competitors are.
Yeah. So, and it's a great question. And I think you always have to play to your strengths, right? And so we're a little company with 50 people in Washington, D.C. and New York, right? The chances of us beating these other firms in terms of artificial intelligence or big data is zero. There's no shot, right? So we have to play to our strengths, which is, again, it's harder work, and so I don't know if it's harder work, but it's different, right? We spend a lot of time talking to people. We spend a lot of time. We try to increase the size of our time horizons, try to arbitrage time horizons. I spend a lot of time reading history, but I feel very strongly that one of the things that's missing from an MBA or business school education in general, feel very strongly about this, is business and economic history. I think because I can tell you, just when, let's say 2008 as an example, I can tell you we did not do more modeling in 2008. There was no model, right? I mean, there was, and I would say similar today, there's no model. This has never happened. We've never increased the size of the Fed's balance sheet by 10 times before. But you can read about other financial crises, other things that happened, about how other people dealt with them, about what the public reactions were, that give you some insight as to how things might go. So I know, again, that might be an unsatisfying answer, but
just because it's fine. I was going to, I want to actually, David's raised his hand, and I want to encourage that type of behavior in the future. So David, I'm going to call on you. Feel free to chime in here, Mr. Linden.
Yeah, thanks very much, Professor Pankowitz, and Jason, thank you very much for joining us today. I'm curious, as a macroeconomic researcher, you are essentially our storyteller when you talk with your clients. And my question for you that I hope will benefit everybody else on this call is, when you tell your story, when you form your narrations, how do you decide what story you want to tell? How do you decide what are the data points that are relevant? What is noise? And how do you tell your story with a beginning and an end?
That's David. It's a very good question, and I couldn't agree with you more. I mean, that's why when I went to Georgetown, I thought I was going to work. I literally thought I was going to work for the CIA. Okay, that's what I wanted to do, and then I fell in love with this business, and then it works because it is kind of a lot of storytelling. It is a lot of a mosaic theory of trying to pull a lot of things together. But it goes back to what I said earlier today. By spending so much time with our clients, so many of the best ideas for our research reports come from our clients, right? So I'm on the phone every day or I'm traveling. And if you in the old days, this doesn't happen so much right now because of COVID, but you go to Boston, you might have 7 meetings in a day and you talk to the biggest institutional investors in the world. What you find is that there's a pattern to the questions. There's a pattern to the things they're asking. There's a pattern to things that they're wondering about or worried about. And oftentimes it's things that you haven't thought about. And that winds up providing us, so it's a little bit cheating in a way, but then we go back and we say, all right, this is, I'll say, David, that's a great question. I don't know how, I don't know how companies trading at 10 times sales behaved the last time the Fed first tightened, but and then we go back to the laboratory, we go back to the office and we look at it and we see, and then we send the client back that information. So that's a big part of it, I would say, is really listening to the clients. And then that also gives us a sense of what's priced in and what's not. The things, so that, and again, what you're trying to look for is the things that aren't priced in too, right? Is what are the questions people aren't asking maybe that they should be?
Is there something you wanted to wrap up with, Jason, that would we really appreciate your time, but I'm going to try and give you opportunity to wrap up if you'd like.
No, I'll throw one thing out here, and now I'm going to get a little bit on my soapbox here, just for a second. The one thing I would just say is that I feel very strongly. I know, especially for younger people, that they're very worried about kind of how their careers fit into kind of a social, some sort of social justice or social goals. And I spent a lot of time on this. I've thought a lot about it, and I don't think it's a rationalization. I feel very strongly that Wall Street provides a very important social function in that it breathes life into the dreams of entrepreneurs and funds a lot of innovation, funds a lot of things that have improved our lives. And I know that these days sometimes capitalism gets a bad name. I don't even really like the word capitalism. I like free markets better. But one thing I can tell you just from running a company is that in its truest form, capitalism or free markets are essentially based on meeting the needs of other people. Like, I mean, again, unless you pay somebody to get a big government contract or something, then that's crony capitalism. That doesn't count. But if you're just a person and you're running a company, you have to figure out something that benefits other people. Otherwise, you won't stay in business very long. So I would just encourage people. I think I have younger kids myself, and I sometimes feel bad for them because I think they're putting too much pressure on themselves to try to do it all. And there's something very noble about just working, in and of itself. So anyway, that's my last little thing.
Well, Jason, thank you so much for your insights and answering the questions. I would like to remind everyone that this recording, along with the others, will be made available on the center's website. And to remind you that tomorrow night, Tim Nolan from Macquarie is coming back in. Tom, was there anything you'd like to add?
No, just thank you, Jason. And we're in an interesting, maybe live in interesting times, and we certainly are living in interesting times. So thank you for giving us some clarity along the way.